When a professional investor looks at a company, they don't just see a stock price going up and down. Nope. They see a puzzle, a case to be solved. They perform this deep, systematic investigation, almost like a financial autopsy. So let's dive in and see exactly how they do it.
And really, that entire complex investigation, it all boils down to this one single crucial question. Because here's maybe the most important lesson in all of investing. A fantastic world-class business is not automatically a fantastic investment. The price you pay for it matters just as much as the quality you're getting. To see how this all plays out in the real world, we're going to roll up our sleeves and break down the analysis of a real company, Persistent Systems. We're going to follow the evidence step by step to see if this great company is also a great investment.
Okay, first things first. Every good investigation needs a subject, right? We need to understand exactly what this company does and what really makes it tick.
So, who exactly are they? Well, Persistent Systems is what you'd call a premium IT services company. But don't think of them as just basic IT support. No. These guys are operating in the most exciting, fastest-growing parts of the tech world. We're talking digital engineering, cloud, and AI. Basically, they're the experts that other cutting-edge businesses hire to build their future.
Look, a good story is great, but for an investor, that story has to be backed up by cold, hard numbers. So let's crack open the books and check the company's financial vital signs.
And wow, right away, the numbers start telling a really powerful story. Over the last 5 years, their revenue has been growing at a compound rate of 18.5% every single year. That is a truly remarkable level of consistent, strong growth.
But hold on, it actually gets even better. Their profits? They're growing even faster than their revenue, at over 22% a year. Now that is a massive green flag. It tells you the company isn't just getting bigger. It's getting smarter, more efficient, and more profitable as it grows.
And here's the kicker. They have managed to pull off all of this incredible growth without taking on any debt. Nothing. The company is completely debt-free with a balance sheet that's just flush with cash. That gives them so much stability and flexibility, especially when the economy gets a little shaky.
Now for a metric that investors absolutely love, return on equity, or ROE. This number basically tells you how good the management team is at using shareholder money to make more money. At over 19%, Persistent is super efficient. Think of it like this. For every $100 invested in the business, they're cranking out over $19 in pure profit. That's the sign of a really well-oiled machine.
So if we step back and look at the financials as a whole, the picture is just overwhelmingly positive. You've got incredible growth, tons of cash coming in, no debt, and really high efficiency. But, and there's always a but, isn't there? No company is perfect. Over on the right, we start to see the first clues of our dilemma: a high price tag, rising costs, and more competition. We'll get back to that in a bit.
So, being financially healthy is one thing, but can the company defend its business from rivals? Let's take a look at how Persistent builds its competitive advantage, what investors call a moat, to protect its profits for the long haul.
And this breakdown of where their money comes from really shows you their secret sauce. You can see that almost half their business is from digital engineering, with data, AI, and the cloud making up most of the rest. They're absolutely laser-focused on the most complex, high-value services that modern businesses are desperate for.
And this is how they protect that business. First, they have this deep expertise that's just really hard for anyone else to copy. Second, their services get so woven into their clients' daily operations that it's a huge pain for a client to switch to a competitor. That creates stickiness. And on top of that, they're known for keeping their best people and just knocking projects out of the park.
Okay, so we've established we have a financially sound company with a solid competitive moat. But remember, investing is always about the future. So, what are the plans, and what does the road ahead actually look like?
Well, management isn't being shy. They've laid out some really clear and pretty ambitious goals. They're gunning to hit $1 billion in revenue while also becoming even more profitable and doubling down on those high-value digital services. It's a very confident, very clear vision for the future.
And it's not like they're fighting an uphill battle. They have some seriously powerful trends at their back, what we call tailwinds. The entire world is going digital faster than ever, demand for AI is just exploding, and big companies are looking for trusted, long-term partners, not just the cheapest option. Persistent is sitting right in the sweet spot to ride these massive waves.
Okay, let's pause. The evidence is in. By almost every single metric we've looked at, Persistent Systems is an exceptional company.
But now, we have to go back to our central question and put the stock price itself on trial. And here it is. This is the heart of the whole dilemma. The PE ratio is a quick way to see how expensive a stock is. And as you can see, investors are willing to pay over 51 times the company's annual earnings for a share of Persistent. The industry average? It's way down at 28. That means you are paying a huge premium for Persistent's quality and growth.
This valuation model tries to get even more specific. Analysts project different futures, and in the most likely scenario, what they call the base case, the stock's fair value is actually about 11% below its current price. So yeah, there's a chance for a big upside if everything goes perfectly, but the most probable outcome suggests the stock is overvalued right now.
And this brings us right to the analyst's conclusion, which is perfectly captures everything we found. The company itself is great, no question. But the price is just too high, and it doesn't leave you with much room for error, what investors call a margin of safety. And that's why the final recommendation isn't a buy, it's a hold. Essentially, wait for a better price to come along.
So we've seen exactly how to dissect a stock, separating the amazing business from its expensive price tag. And it leaves us with that ultimate lesson, and the ultimate question every investor has to ask themselves. A great company isn't always a great investment, so what's the price that would make it one?